Yazdi. I'm a tax attorney. I spend most of my practice or concentrate most of my practice on international tax transactions. So we're going to discuss in detail today the process of expatriation from the U.S., the tax consequences associated with it, and maybe some planning strategies. So um, but before we get into it, I guess the first thing is that we're going to kind of talk about some basic terminology that anybody who's working in this field or anybody who's going to be advising individuals expatriating from the U.S. should know. Then we'll talk a little bit about the history of expatriation tax, the constitutionality of it, because it's been challenged in court a couple times. Then we're going to dive into the actual computation of the exit tax and who's subject to it. Then we're going to talk a little bit about the gift tax, because there is a gift tax that kind of goes hand in hand with the exit tax. Then we're going to actually talk about the actual process, the non-tax actual process of expatriation from an immigration point of view. And then we'll briefly talk about some tax planning strategies as well. For a shameless plug on my behalf, on my part, we do have a pretty detailed article that discusses the expatriation tax. I think it's being published by Thomson Reuters next month. So anybody who likes a little bit further detail on this topic, please go ahead and just send me an email after the seminar, and when the article gets published, I'll forward to you a copy of the article. And as well, I'm always blogging on this topic, so I can also forward you any kind of blogs that we've recently written on this topic. All right, so let's talk about some basic topics that anybody who's dealing with anybody's expatriating should understand. All right, and basically, why do people expatriate? Well, people expatriate because U.S. citizens are taxed on their worldwide income, and the taxes are quite high. So a lot of people expatriate to offset the high taxes associated with foreign source income. So first thing to understand is that U.S. citizens are taxed on a worldwide income. Not only U.S. citizens taxed on worldwide income, but U.S. residents are taxed on their worldwide income. All right. Now, there are exceptions to this rule, which we'll get into as we kind of move along in our presentation. But what are our U.S. resident? Well, there's two types, well, actually three types of individuals that are U.S. residents for tax purposes. The first is a individual, a foreign person, who is a U.S. resident because they've been awarded a green card, right? So if you're if you're a foreign individual, you've been awarded a green card, you're also taxed on your worldwide income. Now, I think anybody who's been practicing in this area for a while will kind of understand this. A lot of people get a green card, they leave the U.S., they're abroad for a number of years, the green card expires, and then the foreign person thinks, well, the green card is expired. I haven't used it in years, therefore it's no good anymore. No, in order for you to terminate a green card, you basically have to go ahead and either have it taken away from you or the foreign individual has to have it taken away from them through a immigration hearing or through a court process, and that process itself has to get to the point that it's non-appealable. So once that foreign person gets to a point that it's non-appealable anymore, and their green card has been revoked, then they are no longer a green card holder. A foreign person can also go ahead and voluntarily terminate their green card. How do you voluntarily terminate the green card? Well, you send it back to the Department of Homeland Security. You also complete what's called a Form I-407, along with a letter of an intent to basically terminate the individual's residency. So the takeaway from this, there is no such thing as an informal abandonment of the green card. Once you get the green card, you have to go through the process. And returning the green card doesn't mean that you go to U.S. Embassy and you throw the green card over the defense and you say, well, I no longer have it. You kind of have to go through the process. Like I said, you either mail it back to the government, or along with a formal intent to abandon the green card, or you go ahead to a U.S. Embassy, the individual makes an appointment, and they terminate the green card at a U.S. Embassy. All right. The final two ways of being a U.S. resident for tax purposes would be first under the substantial presence test. Under the substantial presence test, if you're in the United States for 183 days or more in a single year, you are a U.S. resident. There is an exception to that rule under the closer connection test, but we're not going to get into that for our purposes. The substantial presence test can also be satisfied if the foreign individual is in the U.S. for more than 31 days in any given year, and the previous year they've been in the U.S. for 1/3 of 183 days, and the prior year they've been in the U.S. for 1/6 of 183. So if you add up the prior 2 years to that year being so-called tested, and it amounts to 183 days, taking into consideration the past 2 years, then that person itself is also a resident for tax purposes. And finally, a foreign individual can actually make an election to be treated as a U.S. person for tax purposes. Why is this important? Because, as we'll talk about in a minute, when you're doing the expatriation is done differently for a U.S. citizen compared to a resident. It's the actual calculation of the date of exceptions that can be done is different for a U.S. citizen compared to a resident, and also at the end, when you're actually going through the actual final process of expatriating from the U.S., the non-tax portion of it, they're different. All right, we'll get to that in a minute, but let's talk about the history of the expatriation tax. Why talk about the history of the expatriation tax? Because by going through the history, you will kind of understand why we're at right now and how the law works. Okay, so Section 877 for the Internal Revenue Code governs the expatriation process for tax purposes. All right, so Code Section 877 was revised many occasions. It was first enacted or incorporated into the Internal Revenue Code in 1966. And it basically, when it was first enacted, the principal purpose of it was to basically tax individuals who are leaving the U.S. For tax purposes. And in 1996, it kind of evolved a little bit more. And basically in 1996, you've added for the first time not just U.S. citizens who are subject to the exit tax, but you also enacted a provision for long-term residents. And those were U.S. permanent residents who were in the U.S. for 8 of the last 15 years prior to the termination of their residency. All right, so we spoke earlier about U.S. residency, about the green card test. So basically in 1996, the way that the Internal Revenue Code was amended, it kind of brings those folks into the computation or of the exit tax, and also wound up assessing them the exit tax. All right. So in 1996, the way the exit tax worked, basically there was a presumption that if you're leaving the U.S., you're doing it and you're renouncing your citizenship or you're renouncing your green card, as long as you had an average income over the last 5 years before you expatriated of $100,000 and your net worth was at least $500,000 on the date of expatriation, there was a presumption that you're expatriating or leaving the US for tax reasons, and then you're subject to the exit tax. What could wind up happening at that point is that the individual could rebut this presumption if they ask for a ruling from the Internal Revenue Service. So I'm not sure how that worked back in the day, but that's how it was in 1996. In 2004, Section 877 was revised. It got rid of the facts and circumstances approach, or should I say a presumption of avoiding U.S. taxes for expatriation purposes, and it kind of brought in the alternative regime, which we're kind of seeing now. And basically, under Code Section 877 in 2004, if an individual's annual net income over the past 5 years prior to expatriation was at least $124,000, then and their net worth was at least $2 million, then an individual also failed to certify under penalties of perjury that they're compliant with their tax obligations for the past 5 years, then they would be basically characterized as an individual subject to the exit tax. All right, 2008, the exit tax changed again, and the exit tax established the concept of a covered expatriate. All right, and under the 2008 Heroes and Earnings and Assistance Relief Act, or the HART Act, you now have what is the basis for the exit tax and how it works. All right, so under the HART Act, the way that the exit tax operates, only covered expatriates are subject to the exit tax. All right, so who is a covered expatriate? Basically, a covered expatriate is the following. If the individual, for the past 5 years prior to the expatriation, had an average income of $206,000, and that amount is basically indexed annually for inflation purposes, and this individual has a net income value or a net asset value of $2 million, then they're considered a covered expatriate. All right. Then, if you are a covered expatriate, just because you're a covered expatriate, it does not automatically mean that you're subject to an exit tax, because for 2025, there's an exclusion of $890,000 that is shielded from any exit tax, and that amount is indexed annually for inflation. Last year it was $866,000. This year it's $890,000. That will continue to go up. Now, one thing to keep in mind about that exclusion, it is only good for once an individual's lifetime, right? So if you have a client that is expatriated, they leave the US, they come back, they're not allowed to go ahead and take the annual exclusion again. Now, what you can do is, let's just say they only use part of it, the parts of it that they did not use, if there's a leftover portion, that can be brought forward into future years if your client comes back to US and is subject to the exit tax. All right, so that's the basic framework that we're talking about here on who's subject to the exit tax. Oh, and another provision that was added as a result of the HART Act, there was a so-called inheritance tax, which is basically assessed against individuals who, prior to expatriating, gift away a bunch of their assets to avoid the exit tax. Now, and by the way, that amount, which is assessed, the tax that is assessed on individuals who are subject to this this so-called inheritance tax or this gift tax, is the maximum rate of the U.S. estate and gift tax, which is 40%. There's a number of issues with this, and when I talk about how the inheritance or gift tax is computed and what it is, we'll go over to that time. All right. Constitutionality of it, of the exit tax. So the exit tax itself has been attacked at least twice that I know of. There's other cases too, but at least two cases that I'm aware of that try to attack the exit tax on constitutional grounds. The first case is the Pomanova versus United States. It's a court of claims case. It's back from the early 80s. And in that case, the individual who paid the exit tax, filed a refund claim, said, look, the exit tax itself is unconstitutional because what it does, the government unfairly goes ahead and discriminates against non-citizens compared to citizens. Where citizens are not subject to the exit tax, non-residents who are leaving the U.S. are, and then also this person who sued to the government to try getting back the exit tax that he paid also claimed that the government has a personal jurisdictional issue, meaning that a U.S. court or the IRS does not have jurisdiction over a non-resident alien. The court found the arguments to be interesting. They went through analysis of it, but the long and short of it, at the end of the day, the court said no. They upheld the exit tax, and the court turned around and said, look, Congress has a broad authority to tax, and invalidating a tax statute is an uphill battle for anybody. And basically, if Congress goes ahead and enacts a statute, as long as there's a rational basis for the tax statute itself, it will be upheld. So in that case, the court upheld the validity of the exit tax. Now, more recently, there's a case, Moore versus the United States, which went all the way to the Supreme Court. Now, that case, the individual didn't attack the exit tax itself. What the individual did is they attacked the 965 inclusion. And basically, the individual owned a small portion of a foreign corporation in India. He owned over 10% of the corporation. Since he owned more than 10% of the corporation, he was subject to this transition tax under Code Section 965. The way that the tax code works, as we're all aware, is that if you are a shareholder of a foreign corporation, you're not necessarily taxed on the amount of money that is distributed to you. You are taxed on the earnings and profits of that foreign corporation. And the individual had a number of arguments, including the 16th Amendment argument, saying, look, I shouldn't be taxed because of the 16th Amendment, because I'm not actually receiving anything. So because of that, since I should not be taxed because of the 16th Amendment, what wound up happening is that it went all the way to the Supreme Court, and it was anticipated that if the court goes ahead and invalidates the transition tax under Code Section 965, that the court may also go ahead and invalidate the exit tax itself as well, because it's a tax on something that an individual itself is not actually receiving a distribution from. Well, although the Supreme Court heard the case, they upheld the exit tax. So the exit tax survived constitutional scrutiny again. Okay, so in summary, what are we looking at here? In summary, we're looking at a U.S. citizen or a long-term green card holder who expatriates from the U.S. They're subject to an exit tax. All right. What is the term expatriate? What is it? The definition of an expatriate is a U.S. citizen who relinquishes his or her citizenship, and any long-term resident of the United States who ceases to be a lawful resident under the United States within the meaning of Code Section 7701B6. A long-term resident, as I mentioned before, is anybody who's in the U.S. for at least 8 of the last 15 years, with the years ending with the individual expatriating. All right. Now, a U.S. individual, you leave the U.S., you terminate your citizenship, you're subject to the exit tax. There is some room to maneuver if you're dealing with a long-term resident. So a individual who's a resident of the U.S. because of a green card, they don't become a long-term resident until they hit 8 years. Now, there are ways to potentially stop the clock from running for those 8 year purposes before that individual becomes a long-term resident. And that's by taking a residency position on a tax return. So the way it works is this way. Let's just say you have a green card holder. The green card holder spends a substantial amount of time in a foreign country and the U.S. while they maintain the green card. And let's just say that individual has closer connections to the foreign country than the U.S. And let's just say the country that individual is in has a tax treaty with the United States. And that tax treaty itself, and most of them do, contain a residency provision, contain a tiebreaker provision in the treaty itself. So if that individual itself can go ahead and break residency with the U.S. under a treaty prior to them becoming a long-term resident, because they've not been in the U.S. for 8 years, that stops the clock running. And you can actually find this code provision itself, which discusses taking a treaty provision in Internal Revenue Code Section 877E2. So you could stop the clock running, and you could even, if you're working with a client who's been outside the U.S., let's just say you have a CEO that of a multinational company, for example, and let's just say the company's located in Korea and they spent the bulk of their time in Korea, although they make business trips to the U.S., you might be able to take a treaty position, and you might even be able to go back in time if they didn't take the treaty position and amend past returns to basically stop that 8-year running, that 8-year clock running before they become a long-term resident. There is a small penalty that the IRS can assess against the individual. I believe it's $1,000 per year. Be honest with you, I haven't seen that done, but it's out there. Now, you can't take a treaty position once the individual has been in the U.S. for longer than 8 years. So if you have a long-term resident, they take a treaty position, and they say that they have a closer connection to a foreign country, then that causes an automatic expatriation, and that could be found in Code Section 7706B6. Now, to back up a minute, why would someone take a treaty position other than to stop the 8-year clock running? Because if you could successfully take a treaty position on a tax return, then you could be taxed in the U.S.'s eyes as a non-resident, meaning that you could escape taxation in many occasions on foreign source income. So it's a pretty good planning tool if it can be utilized. Now, the issue with taking a treaty position is that you may run afoul to some immigration rules, and you may wind up, the individual may wind up losing their green card over it. So if you're going to do it, you should always consult with an immigration attorney. But I will say from personal experience, we've done this on many occasions. I've never seen anybody's green card be revoked because they took a treaty position. I've talked to many other professionals too. I've never heard of this happening. But nonetheless, if you're advising a client to take a treaty position, one, to save on U.S. taxes, or to stop the 8-year clock running before they become a long-term resident, for planning purposes of the exit tax, always consult with an immigration attorney. Just make sure that you don't have an issue with it. All right. Now, since we got past the long-term residency and the 8-year rule, let's talk about net worth. All right. So the way that the exit tax applies, the way that you or your client, trust your client, becomes a covered expatriate is if their net worth is at least $2 million. All right. So if the net worth is at least $2 million, you're a covered expatriate under Section 877A2 Cap B. All right. So how do we determine the net worth, right? We all know, I mean, common sense would tell us that it's a net worth of someone's worldwide assets, but how would we define what that net worth is? Well, fortunately, the Form 8854, Section B, which has a balance sheet, provides a pretty good list of the assets itself that are taken into consideration when you make a determination of someone's worldwide assets, or should I say worldwide net worth. And quite frankly, in our day and age, $2 million is not that hard to reach. But what do you take in consideration? Well, you take in consideration marketable stocks, cash, pensions, deferred compensation, certain assets held in trust. We'll talk about that in a minute. Beneficial interest in trust, like we'll talk about it in a minute. Intangibles, loans to U.S. persons, outstanding loans to foreign individuals, real estate located in the U.S. and outside the U.S., business property located in the U.S. and outside the U.S. Then what you do is you will go ahead and any installment obligations against those assets, such as mortgages or liabilities, you'd subtract that, and then you come up with your total amount. And you make a determination whether or not someone is a so-called covered expatriate for purposes of that $2 million rule. Now, there is an interesting exception to this rule. And the interesting exception to the rule can be found in Notice 97-19. And what it provides is that if an individual has a beneficial interest in a non-grantor trust as compared to a grantor trust, a non-grantor trust itself is basically a trust that the individual does not control. The non-grantor trust itself, that interest itself is not taken into consideration for purposes of determining someone's worldwide net worth. All right. You kind of have to go through the trust itself to make that determination. The relevant facts and circumstances, whether it's a non-grantor trust. Also, take a look at Code Section 2512 to make a determination of whether or not the interest itself held in the trust itself should be valued for purposes of the net worth test. Now, what is important, what I tell my clients, get a valuation. Get a valuation of the applicable assets that it can be argued that it wasn't valued correctly. That includes real estate. If you have real estate interests, get it valued. Intangibles, digital assets. Make sure there is something you can kind of rely upon, not just for purposes of the net worth test, but for purposes of the $890,000 exclusion that we'll talk about as well, or we've already talked about. Understand that. We'll talk about this a little later on. The government is looking at these expatriations. They're looking at these forms more closely now. Recently, there was a individual that was indicted for filing a return, an exit tax return. The government claims that the return itself was prepared fraudulently, and now he thought he left the U.S. Now he's defending himself in a criminal case where the government's alleging tax evasion and filing a false tax return. So very important, get everything valued and make sure that you can basically substantiate things that you're putting on the 8854 because these returns will be audited and I believe that in the future since you have an increasing number of people expatriating from the U.S., you will have more more audits as well. All right. Before we move on, there are exceptions to who can be classified as a covered expatriate. There is a couple carved out exceptions in the Internal Revenue Code. So understand that, talk to your client, make sure that these two exceptions don't apply. And one of the exceptions itself is basically because of birth, an individual was a U.S. person, was a citizen of another country, and basically they've been taxed in another country. They don't satisfy the substantial presence test that we discussed earlier for the past 10 of the last 15 years prior to the date of the expatriation. In that case, you might be able, for that dual resident, you might be able to exclude them as being a covered expatriate. And then there's also certain minors. Certain individuals who have relinquished their citizenship prior to obtaining age 18 and a half, and although that individual is a U.S. citizen, probably because of birth, they've never been in the United States under the substantial presence test, should I say, for more than 10 of the last, over the 10 years prior to expatriation. So under those two carve-outs, even if these individuals can be classified as covered expatriates, they still might wind up being excluded from the exit tax. All right. Let's kind of now talk about the application of the exit tax and how the exit tax works. All right. So you take an individual, the individual's assets who is expatriating from the country and from the United States, should I say, and you basically take all their assets on the date before they leave the U.S., on the day before the expatriation date. You take its fair market value. This is why it's important to go ahead and have everything valued, so you don't wind up having a dispute the IRS to what the fair market value of the assets were, and then you basically treat it as a sale. You're allowed their basis. The individuals allowed their basis in the property, as well as any kind of loans against the property itself. That's offset as well from purposes of determining what the exit tax is going to be on the assets sold. However, there are longstanding provisions for the Internal Revenue Code that people in the U.S. take to reduce their liabilities on a sale of assets that do not apply. For example, Code Section 121, the personal residence exclusion does not apply. So if you have an individual leaving the United States, they're taking they're selling their primary residence, 121 does not apply. You can't offset the $500,000 from the gain if they're married, or $250,000 for an individual from taxes. That's going to apply. Also, if you're dealing with an individual selling stocks, the WASH rules under 1091 do not apply. All right. So, for purposes of computing the tax liability for the exit tax, it's a mark-to-market regime. So basically how that works is that the expatriate is considered to own any interest in property that would have been in his or her gross estate for federal estate tax purposes, as if she had died the day before that individual rescinded their citizenship or their residency. All right. Once that amount is determined and a number winds up being determined, then there is an exclusion amount that's applied. So the first $890,000 of gain is excluded. As I said before, that amount is basically subject to inflation. So every single year that's going to go up. So for 2025, $890,000 of exclusion is applied to built-in gains of property that's subject to the mark-to-market regime. As I discussed earlier, you only get one lifetime exclusion of this $890,000. So once again, if your client goes ahead and takes this, and let's just say this is an individual who might come back to the US, always keep a record of the amount of exclusion that was not used, so that could be used at a later date. All right? All right, so after you have the amounts that is determined, which is taxable, all gains and losses are reported on the appropriate schedule of Form 8854. The Form 8854 is the form that is ultimately attached to a tax return, which computes whether or not an individual has an exit tax. It should be noted that an individual can defer an exit tax liability. This is done on an asset per asset basis. It's an irrevocable election that can be made, and one, you have to demonstrate to the Internal Revenue Service that the individual has the security to pay the tax, and it has to also be reported. I believe it's on Schedule C of the Form 8854 if you're going to go ahead and take a deferral on part of the exit tax. If you want some more information on this, you could find this in Internal Revenue Code section 877AB and notice 2009-85. It discusses this in more detail. All right, let's talk about specific assets. Specific assets that could be a little bit confusing or problematic when you're actually computing your exit tax. What we see plenty of in my practice, or our practice here, is individuals that have stock-based compensation, restricted stock units, RSUs, or non-qualified stock option, NSOs. One thing to keep in mind about with stock-based compensation, you can't always value those on the date of expatriation. And sometimes what has to happen is that when the individual exercises the stocks, or just exercise the stocks, that might be after the date of expatriation. So an example of this would be, let's just say you have a executive from Amazon. And let's just say the executive from Amazon lives in Seattle, and they want to go ahead and live in Italy. They're tired of the US, but they're going to get a job in Amazon in Italy, and they have stock-based compensation. So what has to happen is, after the expatriation date is done, on many occasions, that individual from their employer, in this case Amazon, will receive a W-2. The problem is the W-2 itself will basically state the potential tax consequences for the entire time the executive held on to the stock options or stock grants. So that W-2 itself is not going to be, you're not going to be able to use that W-2 to determine the correct U.S. tax liability. So what has to happen is, at a later date, you have to file an NR tax return, 1040 NR, and you're going to have to allocate the gain or the tax consequences of the compensation between the time that they worked in the U.S. and the time they worked, in this case, in Italy or any other country. So it's not always easy to do. You have to have make sure that that's done on the tax returns. You don't want to be over taxing your client. Okay. Other things that are taxed upon expatriation. qualified tuition plans under Code Section 529. Coverdell Education Savings Account under Code Section 530. Health Savings Plans under Code Section 223. Archer MSA under Code Section 22, which is a tax advantage medical savings plan. They're all taxed. They're all treated as basically a taxable event upon the expatriation. For more information about that, you can refer to IRS Notice 2009-85. All right. Another area which is kind of complicated is when we're dealing with individuals who have U.S. retirement accounts. So if you have a U.S.-based retirement account, such as an IRA or a 401k, so your client has it, there are some specific rules that apply when an individual is expatriating from the country, and you have to kind of take into consideration the tax consequences of these retirement accounts. So let's start first with the IRA, the individual retirement account. So let's just say your client has an IRA. Well, the IRA itself is disclosed on the Form 8854, and any taxable gains of the IRA will be subject to the expatriation tax. All right. Now, there are certain situations where an individual can take a treaty position during the expatriation process, or at least in theory can take a treaty position in the expatriation process to shield an IRA and 401k plan, which we'll discuss in a minute. And if that's the case, then you can exclude it from the calculation. The problem is that treaties itself are residency based. So if you're terminating your U.S. residency, it's kind of hard to take a treaty position to exclude an IRA account or a 401k account from an expatriation tax. Where you might wind up in this situation, and more likely, is, let's say someone's leaving from the United States, and they're not subject to these expatriation rules, and after they go ahead and they terminate their residency or citizenship in the U.S., they re-domicile in a country that we have an income tax treaty with, and that income tax treaty itself specifically excludes from taxation an IRA or a 401k plan. Newer treaties are pretty good about it. They specifically spell out IRAs and 401ks. Older treaties are not so good to spell it out. But in any event, there are occasions that you can take a treaty position on behalf of your client to exclude the gains of an IRA account, 401k. That includes the early withdrawal penalty. In many occasions, you could do it and exclude the retirement account from U.S. tax completely. Look at the treaty in detail before you do it. Look at the technical explanations. The technical explanations are really good to determine whether or not you could take such a treaty position. If the technical explanations are not clear, look at the OECD explanations on treaties. Sometimes that can help you out. But the most important thing to consider when you are taking a treaty position to exclude a U.S. retirement account is that you're not taking this with the Internal Revenue Service. You're taking the treaty position with the plan administrator. So you have to complete the Form W-8-BEN, submit the Form W-8-BEN to the treaty administrator, and it's ultimately going to be up to the treaty administrator to determine whether or not there's no U.S. withholding requirements. So, well, I should say you don't necessarily have to do it with the IRS, but the bulk of this is done with the plan administrator. All right, let's just say you don't have a treaty in place. Or let's just say now you have a client, they have an IRA. The IRA itself, as I mentioned earlier, is liquidated for purposes of the expatriation tax, and you're subject to tax on it. What some people do is they maintain the U.S. IRA after they expatriate. It's not a really good idea unless there's a treaty. And I'll tell you why. Just because the individual used or paid tax as a result of the exit tax on the value of the IRA, that doesn't change the classification of the IRA. The IRA will continue its deferred tax status. And what will end up happening is that it will continue to accumulate income in the IRA. And then when the individual goes ahead and removes the funds from the IRA, if there's no treaty in place, then any distribution from the IRAs could be subject to a 30% U.S. withholding tax, and an early withdrawal penalty may still apply. So that's something to keep in mind if you're dealing with a client who has an IRA. If you're dealing with a covered expatriate who has an interest in an IRA, have a form W-8CE given to the IRA administrator within 30 days of the expatriation date. This will provide notice to the administrator of the IRA that the individual is a covered expatriate, and it will also assist in determining the exit tax consequences of the IRA. 401k plans. 401k plans are different than IRAs. As I mentioned, treaties sometimes come into play to reduce or eliminate the tax consequences of a non-resident holding an IRA. However, unlike an IRA, an individual can go ahead and defer the tax consequences of the IRA from the exit tax. So what would have to happen then is, let's just say an individual has an IRA, they want to defer the tax consequences of it. So an election has to be made on the IRS Form 8854 to do so. And also, the plan administrator must be notified within 30 days of the expatriation that you do not wish to have a distribution. This is also done on a form W-8-8CE that would allow the individual to defer the tax consequences of the 401k. Now, if someone defers the tax consequence of the 401k, two things happen. The first thing that winds up happening is that when the individual takes the money out of the IRA, it's subject to a 30% withholding tax, no exceptions. Secondly, the individual can't take a treaty position down the road to eliminate the 30% withholding. So you may want to do some modeling when you're doing your calculation of your exit tax to see if it's worthwhile for the individual to keep the 401k or not, or defer the tax consequences. Now, other types of deferred compensation plans are not eligible for the same type of treatments as a 401k plan. So these are retirement plans which are under Code Section 457, which basically are unfunded or non-qualified plans, and these are administered typically by state, local, and tax-exempt organizations for their employees. All right. So now, since we discussed specific areas that we need to be concerned with, let's kind of go over one last thing. Let's kind of go over the inheritance tax. All right. I mentioned earlier that the inheritance tax itself, or exit tax, or gift tax, whatever you want to call it, it's part of HART. And what it does, and this is Code Section 877A, imposes the highest applicable gift and estate tax rate of 40% on U.S. citizens and residents who receive a so-called covered gift or bequest from an expatriating individual. In other words, if you have a individual leaving the U.S., expatriating from the U.S., and they go ahead and they gift away their assets in order to avoid the exit tax, or in order to not be classified as a covered expatriate. What the code authorizes, in theory anyway, it authorizes an inheritance tax, and the inheritance tax itself is imposed on the recipient, not on the individual actually making the gift, which is completely different than what we all know about the gift tax. So what we know about the gift tax, if we have someone in the US who gifts something away for less than value, and they're giving it to a third party, they're potentially subject to a gift tax as long as, it's over $19,000 per year, and they haven't used up their annual $13.9 million exclusion. So it's the individual giving away the gift that is who's subject to the gift tax. Now here, with these rules, they change the rules because they know that the individual has left the United States. And since they left the United States, there's no way that the IRS can collect the gift tax from the donor. So what they do is they assess an inheritance tax on the recipient of the gift. All right? Now, this is all discussed in the proposed regs. You can find the proposed regs under section 28-201-2G. Now, the issue with this is these are proposed regs, all right? They're not final regs. What does that mean? Now, what we all know is that if the IRS issues a regulation, it goes through the notice and comment procedures and so forth. The regulation itself is binding as law. Matter of fact, in some cases, even more binding than say, the Internal Revenue Code. A proposed reg is not binding. A proposed reg, however, if the same reg that is a proposed reg winds up becoming enacted to become a regulation, it becomes binding retroactive to the date that the proposed reg was issued. Now, I don't know of any cases where the IRS is actually enforcing this inheritance tax. It's out there. You need to understand it's out there if you're dealing with this area. But as of right now, like I said, I don't know of any cases that this is actually being enforced. Now, with that said, there are some exceptions to this rule, all right? So the exception to the rule where the inheritance tax does not apply, if the individual transfers intangible property to an individual that's not domiciled in the US, suppose the transfer of the intangible property to a non-domiciled individual is not subject to the inheritance tax. A transfer of property to a political organization is not subject to the inheritance tax. A transfer of stock in a foreign corporation by an individual not domiciled in the US is not subject to the inheritance taxes. Also, annual transfer exclusions, transfers of which will come under the annual exclusion. Also, transfers that occur as a result of a waiver of a pension right. So these are potential exclusions. All right. Now, just because the IRS may not be enforcing these rules right now doesn't automatically mean that an individual considering expatriating is free from potential tax consequences. Let's just say an individual goes ahead and they have assets and they want to go ahead and transfer the assets to a foreign trust or foreign corporation at the time prior to expatriating. Code section 672F4 broadly authorizes the IRS to recharacterize the gift as a tax. So you wind up recognizing a tax on that transfer. So when the IRS finally goes ahead and starts enforcing these rules and so forth, how are you going to go ahead and report the gift to the Internal Revenue Service? It's going to be reported on a IRS Form 708, which will be filed for each calendar year of the gift itself. All right. So when you're giving a gift away and you're a covered expatriate or going to be a covered expatriate, that's where you're going to report it. On the individual side, not only we have a potential possibility of an inheritance tax down the road, but also don't forget, in certain situations, you may have to report the gift on a Form 3520 Part 4. All right. Let's now go into the actual Form 8854. Let's kind of have a brief discussion on how the form itself works and what are the filing requirements that are associated with, the expatriation process. All right. So when you have a client that's basically expatriating from the U.S., you file a dual status return. Dual status return itself, you're filing a Form 1040, and you're also attaching a Form 1040-NR to the period of time after the individual has expatriated from the U.S. You're also attaching a Form 8854 to the tax return itself. That Form 8854 determines whether or not there's going to be an exit tax imposed. Keep in mind that these forms itself are all filed under penalties of perjury. And as I mentioned, there is already one case out there where someone was criminally prosecuted for filing a return with the IRS that the Department of Justice and IRS Criminal Investigation Division doesn't believe is accurate. So you want to go ahead and make sure that it's done correctly. All right. Let's quickly dissect the Form 8854. All right. What is the Form 8854 and the different parts? So Part 1 of the 8854 is basically asking the client for basic information, such as the date the individual has become a resident of the U.S. And when the residency itself has been rescinded. Then it goes on to Part 2. So Part 2 of the form is designed to determine whether someone is a covered expatriate or not. So under Part 2 of the form itself, the first question that's going to be asked is of the individual who is actually the form is being prepared for, the tax liability for the prior 5 years. So if the annual tax burden for 2025 is over $206,000 over the preceding 5-year period, then you're looking at a covered expatriate. Line 2 discusses the net worth of the individual. In order to determine the net worth of the individual, you're going to have to, what we recommend is to go ahead and to value all the assets of the individual to make that determination. All right. Line 3 will ask the expatriate individual if, when they became the birth of when they became a U.S. citizen, and if they were a U.S. citizen because of birth or not. Line 5 asks the expatriating individual if they were under 18 and a half on the date of expatriation, and if they were a U.S. resident for not more than 10 years. This is for purposes of ferreting out whether this individual can be excluded from the expatriation tax. All right. Let's move on to Part B. Part B is basically, it's a balance sheet. Part B is used to determine the net value of somebody for purposes of the $2 million threshold. All right. As I alluded to earlier, this is a really good way of determining, the assets that the IRS considers whether or not somebody is a covered expatriate or not. It's a good idea always to kind of go over this with your client prior to them, prior to actually working with them and preparing the return, to determine whether or not they meet that $2 million threshold, and also whether or not the $890,000 exclusion can exclude most or hopefully all the potential gains that they have. All right, Part C. Part C basically discusses deferred compensation plans and so forth, and make a determination whether or not the individual is subject to the exit tax. All right. So
Anthony, going back to Section B of 8854, we've had some clients that get kind of confused when they are expatriating and their spouse owns, let's say, a home
right.
with them. And, in calculating the fair market value and the adjusted basis,
right.
What would you kind of let them know as kind of just how it is to calculate that?
Well, it's going to actually discuss a little bit more in planning.
Mm-hmm.
But if the two spouses are expatriating, then it doesn't matter, right? If one is expatriating, then you have to go ahead and see if you can partition a property. The problem is that most people hold their property joint. And since you're holding it joint, that becomes difficult to go ahead and make an allocation.
Mm-hmm.
So part of the planning might be is if one spouse is expatriating and the other is not, what you may want to do is change title of the property itself. If you're doing it back east, maybe a tenancy by the entirety, or tenancy in common every place else. No, actually not tenancy by the entirety. Actually, tenants in common would probably be the way you want to do it.
And probably just as a general practice point, we probably, you'd be surprised how many people aren't clear about how it is that they hold title. And so
right.
Requesting a copy of the deed in that scenario would be something good
Absolutely.
to have in the file.
Absolutely. That's an excellent point, Karen. Excellent point. All right. Since we're running a little low on time, I'm now going to jump into the actual process of expatriating. So we talked about the tax ramifications, but there's an actual process that your client has to go through when they're expatriating. So there are two different processes. One process is someone who is basically a green card holder, a long-term resident, what they have to do, compared to the U.S. citizen who's expatriating. It's easier, it's simpler for the long-term green card holder. Basically, I think I alluded to this when we first started talking. You have to go ahead and send the green card back to the government, and you have to go ahead and include a Form I-407 stating that you intend to terminate your U.S. residency, or the client's intending to terminate their U.S. residency. Now, the Form I-407 has changed. It was a little simpler in the past. Things have kind of changed now a little bit on that form itself, and anybody who's preparing these on behalf of the client or reviewing it should kind of understand it. Now, let me back up a second here. Whenever in our practice, when we're dealing with a long-term individual terminating their residency, I like to have them send to us their green card, and then we'll complete with them the I-407 and send that to to the government. And the reason for that is when they're actually giving up that green card is when they stop their U.S. residency for tax purposes. You want to make sure you can track that. And if the client goes ahead and does it on their own, a lot of times they don't do it correctly, they send it to a wrong address, or it gets lost, and then you have a situation where someone didn't leave the U.S. when they give up their residency when they thought that they did. All right, so that's how we do it. That's anybody can do what they want, but make sure that however it's done, there is a record kept of when that green card itself is sent back to immigration. All right. real quick, the important points of the I-407. So, alien registration number has to be disclosed on the form. The individual who's terminating their residency, they have to basically print their names exactly how it's on their permanent residency card. If they're issued a USCIS online number that was used to file a petition for residency in the past, that has to be stated on the form itself as well. Also, if there is different names that has been used by the client, that should be on that form. Also, the date of birth and the country of birth and country of citizenship and nationality needs to be disclosed on the form I-407, as well as the last date of departure from the United States should be on that form itself. That's very important, and I would back that up. I'd keep a copy of the airline ticket, or however that individual left the U.S. in case the IRS audits it or there's an issue that should wind up popping up in regards to when that individual actually left the United States. On the form itself, it asks the expatriate individual to list an email address. I typically put our email address on there in case there's any kind of communication, with the government, the Department of Immigration Authorities. Now, the other important changes that have happened with this form in the past, the form I-407 asked if the individual wanted to hold on to their green card, and if so, explain. Now the government wants the green card, and if the individual can't turn over the green card, they want an explanation of what happened to the green card, such as it's been lost, and so forth. So, definitely want to make sure that the green card itself is sent to the government, and if it's been lost because it's so old, an explanation itself, a detailed explanation is stated on the form I-407. If there's a translator that's preparing the I-407, the translator has to state their name, their qualifications, and so forth. That's a change to the form I-407 from the past. And if you're preparing the form I-407 for your client, this is something new also, you're gonna have to basically state, who you are and that you went ahead and you examined the information stated on the form I-407. So I don't know if the form itself is prepared incorrectly, if you could have a situation of a return preparer penalty. But it's something to keep in mind. This is something new, and if you are preparing this on behalf of your client, do your due diligence. Treat this like a tax return. You don't want to wind up having the government examine your preparation. All right, U.S. citizens. U.S. citizens, it's different when you're expatriating. So, a U.S. citizen, the way it works is that first, that individual has to make an appointment with an embassy. All right. Sometimes it's not always easy to get an appointment with the embassy where the individual is now residing, so they actually may have to go to a different embassy. But nonetheless, you have to make that appointment first, all right? Secondly, prior to the appointment, a Form DS-4079 has to be completed. Like the I-407, there's been recent changes to it. So that it's actually become quite complicated. It didn't used to be so complicated. Also, when the individual goes to the meeting, they need to bring their passport. And on top of it too, a check. Expatriation for U.S. citizens, it's not free. I think right now it's $2,350. A check has to be made out to, or a money order or a payment has to be made out to the State Department, a U.S. State Department, for the privilege of expatriating. All right. One other thing I forgot, you also need to bring a certificate of citizenship that you're a resident of at least one country other than the United States for the expatriation meeting with the embassy officials. So what you do, U.S. citizen, they make an appointment with an embassy to meet with someone in the embassy, to have an interview, to basically be relieved or renounce their citizenship. And the form DS 4079 is given to the interviewing officer, and then the U.S. person, U.S. citizen who wants to expatriate, is given a decision. Not at the end of the interview, they're given a decision from the U.S. government, typically a month or two after the meeting. And it should be understood that there is no right to expatriate. The Department of Homeland Security could turn around and say, no, they decline the request to renounce U.S. citizenship. If that is the case, the individual seeking to renounce their citizenship can go ahead and sue in a United States district court and challenge that determination, but it's something to keep in mind. Now, what is in that form DS 4079? So it starts off simple: name, email address, date of birth, how you acquired citizenship, ties to the U.S., such as an address, residency, any kind of ties to U.S., such as professional licenses, Medicare benefits, disability benefits, retirement benefits, U.S. driver's license, immigration benefits. That has to be all disclosed on the form 4079. If you're a citizen or the client is a citizen of the other country, a statement has to be stated on how that individual became a statement of that other country. And I said that this form itself is more complicated than the I-407. It is now, and this is a change from the past, a written description has to be stated on the form what influenced the individual's decision to renounce citizenship and to basically become a citizen or take an oath in another country. Also, a statement has to be there whether or not the individual felt pressured to take oath of renunciation. A copy of a certificate of naturalization of the foreign state or on the date of naturalization has to be attached. Also, if the individual served in the military in the foreign country, that has to be disclosed. If the individual expatriating was employed by a foreign government and the details of the employment, that also has to be disclosed. So if you have a chance to take a look at the form itself, it's pretty detailed, and you can clearly see if some of these answers are suspect, how this could lead to an investigation not just by the Internal Revenue Service, by other government agencies as well. So very important to properly prepare this return and take time to prepare this return, so you don't have your client have a situation that they're being investigated by the Internal Revenue Service after they wind up leaving the U.S. So now we're going to talk real quick about expatriation planning. But before I get into it, there's one thing I forgot to mention. If you're taking a position with a 401k that you're deferring the taxable income, if you've taken that position through the expatriation, that there's a deferral, that individual has to file a Form 8854 with the Internal Revenue Service every single year until the 401k is actually terminated. This kind of allows the IRS to keep tabs on the 401k, make sure that they get their taxable income. So even after you wind up terminating your citizenship or the individual citizenship, um, you know, keep that in mind that you still may have a filing requirement, as also, as we discussed, the compensation as well for stock options or stock-based compensation. Okay, expatriation planning. What can we do for expatriation planning? Well, the number one thing, if you can do, if it's possible, is to try to reduce the net worth of an individual below $2 million, if it's possible. How do you do that? Well, we've talked about the issue about the gift taxes in for purposes of expatriation, and how, you know, at this point in time, it's unsure what the government's going to do with that. So one potential plan, although there is a certain level of uncertainty to it, is that the U.S. citizen or the U.S. domiciliary, which is basically a resident who's domiciled in the U.S., they go ahead and take advantage of the $3.9 million exclusion for gift taxes, and they basically gift away their assets to family members prior to expatriation. Karen talked about earlier about if you have a spouse. If you have a spouse that doesn't plan to expatriate, one potential way of minimizing or reducing your overall net value below $2 million is to go ahead and gift it to the spouse. You can make you could gift annually if you have a non-resident spouse, or should I say a resident spouse that's not a citizen, of $190,000 in 2025. If the spouse is a U.S. person that's expatriating, and then you have an unlimited amount that can be transferred. If you can't get below the $2 million, if you are gifting, and if you have a choice between what to gift assets, highly appreciated assets if you can, or the client can. So you can't get under the $2 million threshold. If you go ahead and gift away highly appreciated assets that have low basis, you might be able to minimize the exit tax. Also, someone may want to gift, if it's possible, gift to a trust that is a non-grantor trust. If done properly, then you could wind up potentially avoiding the exit tax on potential future distributions from the trust. And it should be taken in mind that if you're going to do this strategy, it should be a U.S. non-grantor trust, not a foreign non-grantor trust. If you gift away to a foreign trust, the gift itself could be subject to tax as soon as you wind up gifting that away. All right, and the trust also needs to be irrevocable. Okay, I think we went over quite a bit here. So that brings to the conclusion the seminar on expatriation. I hope that everyone found this insightful. We may have time for one or two questions.